Hello and good morning. Thank you to all of you who have taken time to join us today. This event is jointly organized by Bursa Malaysia and Investment Bank, and the focus area will be on the outlook for the Malaysian economy and the stock market. I would like to thank the World Bank for agreeing to be our guest speaker today. My name is Shadida from the institutional broking team of Investment Bank, and I'll be your host for today. This is indeed the first time that we are doing a conference of this size online, having to adjust, of course, to the current situation that we are in. We're seeing economies worldwide stalled by partial or full lockdowns, and Malaysia is no exception. The world has been inflicted by this pandemic COVID-19 at a time when most economies are already challenged by many other issues. We have invited Dr. Richard Record, lead economist at the World Bank here, to give his assessment of the current situation and outlook for the Malaysian economy. There will be a question and answer session after his presentation, and I encourage you to share your thoughts by participating in the discussion. After we are enlightened by the macro picture, our session will move on to the stock market outlook, during which our research team, led by Joshua Ng, will give their presentation on how the corporate world is coping with these uncertainties. A quick reminder before we start off for all of you to please mute your microphones when the speakers are doing their presentations. Without any delay, I have great pleasure in inviting Dr. Richard Record to start his presentation. Over to you, Dr. Richard.
Hope everyone can hear me, and thank you for that introduction. So I'll now share a small slideshow and hopefully take you through that over the next 20 minutes or so. And then afterwards, I'd be very happy to answer any questions or discussions or points of clarification. So basically, the presentation has sort of two or three main parts, really. Firstly, I was going to start off a little bit with the sort of global and regional context of how we've seen the COVID-19 shock develop and its implications across the global and regional economy. Then a little bit about the impact directly on Malaysia's economy. And then finally, some of the policy elements, including the economic stimulus package or packages, and how much fiscal space the government really has left to do anything more if we see a prolonged outbreak, as well as some of the risk factors. So, but in broad terms, we're seeing, of course, a shock that started out as a supply shock in China. And when we sort of rewind back to January, of course, which feels like an awfully long time ago, we were thinking really about a supply shock and how that was affecting Malaysia's economy and economic activities that were integrated into those supply chains. Of course, it's now evolved into a pandemic, and we've seen a global economic shock. And according to our projections, at least from the World Bank, we're now projecting a global recession. And that has a very different impact, of course, to the economies of this region, including Malaysia. And then you sort of add, thirdly, to that, the actions that have been taken by the government here through the MCO to try and flatten the pandemic curve. And we can add a sort of domestic supply shock. And so we have these sort of three different dimensions, all having an impact on Malaysia's economy. And of course, all having a very uncertain impact on Malaysia's economy. Perhaps sort of adding to all that as well, of course, we really don't know how long the outbreak will continue, how well it will be contained and suppressed, given some of the measures that have been taken so far in Malaysia, although there's perhaps some signs of optimism. Of course, Malaysia went into this crisis with perhaps not quite as much fiscal space as would have been desirable. And of course, we've had that political transmission right in the middle of this as well. Anyway, if I can take us back to the global picture, and let's have a look at how we've seen some of that evolve. Of course, I think everyone's familiar with these type of logarithmic curves showing the evolution of the caseload across different countries of the world. I think what's interesting in Malaysia is that if you look at the sort of evolution of the trend line against some comparators, the rate of growth about sort of 10 when the MCO was just being started, and during that first week was essentially projecting a doubling of cases in Malaysia every 3 days. But essentially that sort of takeoff hasn't quite occurred, and we've seen the trend line actually now just passing the rate at which they would double every 5 days, perhaps giving some indication that we're moving towards a flatter trajectory. But of course, this is very hard to tell. Globally, perhaps one of the major issues which has been affecting trade and services has been the shutdown of international travel across countries of the world. Malaysia is part of that, and essentially almost every major trading partner has now experienced a major shutdown. And this is having sort of, although it's perhaps necessary as part of the control of the transmission of the disease, is having a major implication on international trade and services. Unsurprisingly, we've seen major volatility in financial markets, and I think the next presentation will go into this in more detail. But certainly already the high frequency data that we have on manufacturing and services PMI shows a very sharp deterioration from February onwards. And we've also, of course, seen very significant emerging market outflows on a scale that we haven't seen for something like 20 years. Equally as well, we've seen an awful lot of disruption in commodity markets. Perhaps most significantly, you can see on the left-hand side, we've seen a significant structural decline in energy prices. We've seen weakness in metals and minerals, although agricultural and food-based commodities have seen some volatility, but have held up much more strongly, and perhaps there's sort of obvious reasons why that would be the case. That chart on the right just shows you how much things have changed just in 1 month. That's the differences. Percentage differences between March and February. Of course, leading the way down has been crude oil prices that have dropped 40%. Now that's not just that's not just related to COVID-19. It's also related to the price war or disagreement in the OPEC group, principally between Saudi Arabia and Russia. But of course, it comes at a time where demand for crude oil has dropped extremely dramatically. Interestingly, you'll see sort of metals and minerals having relatively different performances, often depending on the extent to which a metal is used for industrial purposes or as a store of value. So, of course, gold has held up much better than, say, platinum. And, of course, perhaps food products have seen something of a mix. I think food products which are used mostly for industrial production, like sugar, have seen major declines. But food products that go mostly for household consumption, for example, rice at the top, have actually seen increases over the last month, suggesting concerns around food security and international trade. So from the World Bank side, the scenarios that I'm going to present in this slide and in several other slides over the course here are drawn from the work that we published last week, which is our new regional economic update. And in that, we essentially presented two scenarios, what we call a baseline pandemic scenario, and then an amplified pandemic scenario, or what you might call a lower case. And these numbers are percentage differences from the trend rate. But essentially, under our baseline scenario, we're expecting essentially China to lose almost 4% of its growth projection, and in a negative scenario, more like 5%. Similar numbers across those numbers, and essentially if you rewind to last December, we were projecting world GDP growth this year of about 2.5%. We now expect that to be in the baseline scenario a little bit under zero, and in the pandemic scenario a couple of percentage points under zero. And of course, if you start looking at the different impact channels of the pandemic, you can see that the initial one has been very much the impact on economic linkages between the Chinese economy and other economies in this region. And Malaysia kind of falls about the middle in all of these charts across other countries of the region in terms of manufacturing, commodities, and tourism. But certainly when we saw China itself implement a major lockdown, that had an immediate impact on sort of fast-track impact on all economies were integrated in that way. Of course, since then, we've seen the enactment of major movement restrictions, including in Malaysia and in pretty much all major economies in the region. And that sort of changed the economic impact of the shock from an external supply-side impact to now a domestic supply-side and a domestic demand-side impact. And that has very different implications for public policy and for stimulus measures, given the nature of the shock. And essentially, I'll come a little bit more onto this later on, but I think it's fair to say that most economies around the world in recent economic history have never had to deal with a domestic supply-side shock, or not least on this scale. And a lot of the past experience in responding to crisis has been essentially responding to a demand shock. But many of the tools that worked very well in the past priming the pump, stimulating domestic demand, stimulating public infrastructure investments, will only work once the supply side shock on the domestic economy has been dealt with effectively, and we're in a recovery phase. Until then, essentially we need a different set of policy measures and responses to deal with the crisis. So zooming back into the region, under our two scenarios, you can see Malaysia there with our sort of projected changes from the baseline in terms of growth and exports. But in broad terms, under our baseline scenario, which is essentially, you might even call it a sort of moderately optimistic scenario, but it's one under which we would expect to see most of the disruption contained by the end of the third quarter and the beginnings of a recovery towards the fourth quarter of this year. Under that scenario, we would expect to see Malaysia's GDP growth shrink by negative 0.1%. So essentially about flat year in, year out, reflecting, of course, a little bit of growth in perhaps the first 2 months of the year, contraction and recession during Q2, Q3, and the beginnings of recovery in Q4. Under that scenario, we'd also expect to see a contraction in exports and a contraction in investment, very modest growth in consumption, and a stronger impulse from public sector consumption. Under our sort of lowercase scenario, we would see a deeper and longer impact on Malaysia's economy as well as on other economies in the region. And of course, with essentially that would imply a deeper global recession and a longer duration of containment and suppression activities, with a recovery not really coming until the first quarter, starting to come until the first quarter of 2021. In that scenario, we would see China also moving into a full year recession this year, and Malaysia experiencing a deeper contraction this year of negative 4.6% of GDP, and most likely a slower recovery in 2021. So two scenarios, I think a baseline and sort of cautiously optimistic one, which would see an impact this year and a recovery in 2021, and an amplified lowercase scenario that would see a deeper impact this year and a slower recovery next year. And so that, if those are our scenarios, then the question is, well, what type of response do we need from governments, including in Malaysia's? And I think many of you will be familiar with these curves, certainly the one on the left-hand side. The effort around the world to sort of flatten the pandemic curve to ensure that the caseload of COVID-19 patients falls within health system capacity. But there's equally what we call a recession curve on the other side of that coin, if you like. So the deeper the efforts to flatten the pandemic curve, the deeper the likely economic impact that would come without accompanying macroeconomic measures in terms of both monetary policy, fiscal policy, and financial sector policy. And so the question really is, how much can governments, including in Malaysia, flatten the pandemic curve without resulting in a deep recession curve, or by putting in place sufficient measures that would minimize or mitigate the depth of that curve on the right-hand side. But certainly, globally and across the region, we've been sort of articulating 5 main messages, which I think also apply in Malaysia's case. Firstly, urgent efforts to boost healthcare capacity. And in many ways, Malaysia is in a better place as a starting point than many other economies around the world. Adjustments in fiscal and monetary policy to meet the crisis, and these are in almost all cases unprecedented in scale and depth. In the financial sector, efforts to both ease access to credit for households as well as easing and freeing up liquidity for firms to help them survive the current disruption. We do believe it's critically important that trade policy stays fully open. I think this matters for Malaysia, perhaps even more so than many other economies around the world. Of course, Malaysia is a net food importer. And interestingly, when you look at healthcare products, Malaysia has a very interesting place in the world supply, particularly of personal protective equipment for frontliners. Malaysia supplies 65% of the global demand for nitrile sterile medical gloves, which of course is a critical element in the PPE in the response to COVID-19. So Malaysia is the most critical global production point of that particular product. But of course, in many other areas, be it face masks and all sorts of other medical devices and equipment, Malaysia is a net importer. And so this perhaps, in one particular area emphasizes the importance of continuing an open trade policy around the world. There's certainly enough medical equipment and food policy around the world to meet all the demand that we foresee, but that's conditional on trade routes remaining open. And of course, finally, efforts that we would emphasize to boost international cooperation to ensure the continued supply and increased production of critical medical products, as well as efforts towards moving towards antibody tests and the development of a vaccine in due course. So anyway, moving swiftly on to Malaysia's particular case. Again, I won't spend too much time talking about domestic markets since we have another presentation coming along, but I think all of you in this audience will be well aware that we've seen major declines in the KLCI, and the ringgit has been under significant pressure over the last few weeks, and that reflects the broader EM outflows that we've seen across the EM space. Early indicators also in Malaysia suggest sharp declines in economic activity. Exports and imports already started to decline quite sharply in February, reflecting the supply disruption, and early indicators suggest that will be significantly deeper in March, as well as those capital outflows. In terms of the numbers, this is perhaps in tabular format what I just explained on the other chart, but our baseline projection, as I mentioned, in 2020, well, our baseline projection is for essentially a flat economy in 2020, with a recovery coming in 2021. Very weak private domestic consumption in 2020, helped by an increase in government consumption, but declines in investment as well as exports and imports and net exports. At the sectoral level, we would expect a fairly sharp decline in growth in the industrial sector, and sort of essentially flat or a little bit over flat in agriculture and services on a full year basis. Of course, Malaysia's positive current account balance is maintained and helped during that period, but would likely lessen somewhat. Under that scenario, we would expect to see a strong recovery in 2021, with a growth at 6.4% before perhaps returning to trend rates from 2022 onwards. As I mentioned, though, we do also have a lower case scenario, which is premised on a deeper contraction, a longer suppression period, and a deeper global recession, including particularly in China, and that would result in a fairly severe contraction in GDP growth in 2020 and a partial recovery only in 2021. Three main risk factors that we would perhaps highlight, which would perhaps determine the extent to which whether we experience the baseline or the lower case scenario. As I mentioned, of course, a more prolonged outbreak that results in a longer than expected period of movement restrictions and restrictions on economic activity. Secondly, and I'll go into this a little bit more detail in a moment, the increasingly depleted fiscal space. What's become clear is essentially MOF has kind of thrown just about everything they have now at this economic stimulus, and if they want or need to do more, they're going to probably require some unorthodox responses and possibly legislative change. And of course, running along in the background, of course, is the continued uncertainty of the political situation in Malaysia and particularly of the ruling coalition. So if you don't mind, I'll go a little bit more now into the fiscal impact, because it's certainly an area that we've been working on quite closely in the last couple of weeks. So in broad terms, I won't go into too much detail here, but Malaysia now has an aggregate stimulus package of about 260 billion ringgit. That comes to a little bit over 17% of GDP. In global terms, that's pretty large. It would put Malaysia towards the top end of what we see in advanced economies, and certainly much larger than what we see in most emerging market and developing economies. But if you sort of include or focus only on the direct fiscal injection, it's actually quite modest compared to what we see in advanced economies. So including the additional measures announced on Monday, that now comes to 35 billion ringgit, so about 2.3% of GDP. Which essentially is the direct fiscal injection or the increase in aggregate demand resulting from those measures. And essentially that reflects those elements that MOF has put additional resources into, particularly the wage subsidy and the cash transfers and additional grants. If you now sort of project those new measures onto Budget 2020, expectations, of course, going into this year would be, for example, oil at $62 a barrel. That's the projection MOF had in the budget. and growth at more like 4.5%, reflecting in sort of revenue growth across all instruments. Our assessment is that MOF is now projecting revenues at around 222 billion for this year. From the World Bank side, we think there may well actually be somewhat lower than that. I think there is still perhaps a slightly optimistic oil price assumption implicit within MOF's current revenue projections. But in broad terms, we'd expect, according to our assessment, revenue to fall by somewhere between 22 and 29 billion ringgit. About half of that is petroleum-related revenue. Of course, within that, there are multiple buckets, including royalties, petroleum income taxes, and the dividends that come from Petronas. Only the royalties and petroleum income taxes are directly volatile relative to the oil price. The dividend essentially is negotiated. Of course, with slower growth and particularly weaker activity in the industrial sector, as well as measures that have been announced as part of the various stimulus taxes, we would expect declines in the revenue collection for corporate income tax as well as personal income tax. Something of a decline for SST, reversing the sort of strong organic growth we've seen there. Consumption is holding up reasonably well, but not by as much as we would expect. And of course, there are a number of policy measures that have allowed for additional exemptions, as well as some other areas, opens up quite a large revenue gap. So, of course, we have a government which is challenged with needing to spend more and stimulate, while also finding its revenues under pressure. I think the question really is, what does MOF do to try and fill that revenue gap? According to our analysis, we looked at a number of, essentially two scenarios. Scenario one, essentially, is MOF implements a stimulus package as announced, with no new measures to raise revenue, particularly non-tax revenue, in which case we could see the fiscal balance increasing dramatically to over 6%. And also in that case, Malaysia would probably breach the 55% federal government debt limit. Or scenario two, which I think is what MOF seem to be most likely looking at, which is a number of measures that would keep the fiscal deficit contained, possibly below 5%, and try to keep debt just below 55% of GDP. And I'll come on to what those measures might be in a moment. But in broad terms, of course, the stimulus package includes mostly off-budget measures with a relatively small fiscal injection. Of course, a large part of that as well is not just the moratorium on loans, but also withdrawals and lower payments from pension fund contributions, which of course possibly store up problems in the future. And concerns about even with increases, the level of the wage subsidy still is well below what we see in advanced economies, and complicated requirements can possibly make that difficult to access. So what are government's options if it needs to increase, perhaps if this crisis goes on for longer than expected, and there's perhaps pressure to increase the scale of the stimulus package with either additional cash transfers or further wage subsidies? When we look at the number of, Malaysia has benefited from a number of fiscal rules that have helped over the last 20, 30 years build international credibility around the public debt markets. But those fiscal rules now impose a number of restrictions. I won't go through all of them, but they're embedded in multiple pieces of legislation, which impose limits on the total level of public sector debt, the share of debt services charges as a level of revenue, as well as actual limits on foreign debt. But most critically is this one embedded in the Local Loan Act of 1959, which requires that operating expenditure must be financed by revenue. And essentially, this is the legislation which divides the government accounts into the operating budget and the development budget, and requires that all operating budget expenditures be funded by revenue, and that any borrowing, either domestic or foreign, only be used for development purposes. And before I go on, that imposes, in many ways, that's the most challenging issue that Malaysia has right now. Because if you look back to almost every experience of past crises that Malaysia has experienced in the last 20, 30 years, be it the GFC, be it the Asian financial crisis, the response was to stimulate demand through development spending, particularly on infrastructure and construction. Whereas the reality is that's probably not until we get into a recovery phase is that going to work. The challenge is most of the expenditures that the government needs to invest in right now to mitigate the impact of the crisis and protect the economy from this supply side shock are on the operating side, essentially transfers and subsidies. And this makes it very difficult for the government to scale up beyond what they already have. In terms of, well, so what are the options? Well, one is perhaps if those are the current limits, government cannot borrow to fund the operating budget, then what can it do to try and fill the existing gap that's already been identified? Is one, well, we've listed a number of these here. One is to look at supplies and services. We think there's definitely scope to reallocate some of that, although obviously perhaps not supplies and services related to the health sector or security services, but there's some scope, but that's some billions of ringgit. Grants to statutory bodies as well can perhaps be moved around somewhat, as well as subsidies and social assistance. But some of the other areas, much more limited. I think particularly in the current climate, it's very hard to see any change in grants to state governments. Changes in emoluments, which is by far the largest item on the government's operating budget, 82 billion ringgit. I don't think we'll see any major hiring in the public sector or wage increases outside of frontliners, but still it's hard to imagine anyway, in a situation whether that or retirement charges could be adjusted. And of course, debt service charges, which are the second biggest expenditure item, are also unable to be changed. What else is there? Well, option 2, which I think is what MOF has probably already agreed in principle, is to look at non-tax revenue and essentially the return on investments from GLCs. The biggest one, of course, is Petronas, which is currently earmarked for 24 billion in budget 2020. I think we can almost certainly expect that would be the most likely source of additional non-tax revenue to help meet the gap between the revenue and operating expenditures and revenue the government has this year. Perhaps also Khazanah and BNM, similar to how they made additional contributions last year to fill some of the gap on GST refunds. Sales of physical assets, of course, that helps, but of course, this is perhaps not the best time to be looking for the highest possible price in government's investments. Or perhaps option 3, which we've sort of in the World Bank team call the nuclear option, is if the government really needs to go large, it would need to undertake legislative change. One, to perhaps increase or temporarily increase or absolve the government from the 55% GDP limit. In some ways, that's not too complicated. It can be done essentially through a publication in the Gazette, raising the requirement and perhaps giving the situation and circumstances under which it's raised, possibly temporarily. Or more complicated, looking at tabling amendments to both the Local Loan Act and the Treasury Act and the Government Funding Act to perhaps temporarily allow for operating expenditures to be funded from borrowing. Whether that's feasible, I'm not sure, particularly given the current political climate. But essentially, this is what Indonesia is already looking to do on a temporary basis. So finally, perhaps just to conclude that despite the multiple challenges, when you look across the region, we would argue that Malaysia's economy is in fact quite resilient. It does benefit from a diversified economic structure across multiple sectors, commodities, non-commodities, manufacturers, non-manufacturers within the commodity space, both oil and gas as well as agricultural commodities. Our assessment of the high level of relative digital adoption in Malaysia, well over 80% of the population has access to broadband internet, means that the extent to which the economy can, in relative terms, continue and operate during the MCO is somewhat higher here compared to many other economies in the region, perhaps bar Singapore. The current account surplus acts as a very strong buffer, as well as a past track record on macroeconomic management, given some of the turbulence that we're seeing in markets. Of course, the deep domestic capital markets mean that Malaysia, unlike some of its neighbors, is not dependent on foreign capital flows to finance government operations. And so far, the sort of resilience of the financial sector experience, as well as Malaysia's track record in dealing with the GFC and the AFC in the past, helps. And finally, although I think the Director General Health mentioned yesterday, it's not clear if Malaysia is winning or losing yet on the health sector side, but most indications, including from the World Bank on health system capacity in Malaysia, suggest that Malaysia is quite well placed from that extent. We've seen a rapid deployment of the economic stimulus package, large in aggregate terms, although perhaps not so large in terms of direct fiscal, and the early response of the MCO and the stimulus packages perhaps bodes well for a relatively better response compared to some other economies in the region. In terms of the economic recovery stage, and we know that now that the EPU is focusing intensely now on a post-crisis period, we think it'll be important to try and undertake measures that can restore private confidence and boost private investment, although there's going to be limited fiscal space to do that. And so it might need to be, I think government might need to be creative in that regard. Of course, Malaysia's medium-term challenges around human capital and productivity won't go away, and will need to be addressed in the recovery period. Perhaps there's an opportunity now to look at competition in protected sectors, and particularly looking at services liberalization as an effort to stimulate investment and growth afterwards. And of course, I think the MCO and all the restrictions that have imposed perhaps continue to highlight some of the structural challenges Malaysia has, including on female labour force participation, which will hopefully be addressed as part of a response package. So with that, I think I come to the end of the presentation. There are 3 resources I can perhaps direct you to on the back page here. We have a global COVID-19 resource page on the World Bank site. It has all kinds of information and analysis already done on different dimensions and aspects of the coronavirus and its impact on the global economy, from trade, public finance, debt, investment, and economic activity. Our most recent economic report for East Asia in the time of COVID-19, published last week, has a lot of information. And of course, we have lots of things on our country page as well. Thank you very much. Back to you, Shadida.
Thank you, Richard, for that very concise presentation and for highlighting to us a few of the issues. For example, the effectiveness of the policies that's being undertaken, and also the issue with the increasing revenue for the government and the limitations that they have. I'm sure there are more questions from the rest, so I will open this event to the rest of the participants to ask questions. May I ask whoever is going to be asking questions to please unmute when you're asking the question and put it back on mute when Richard is speaking. We're on the Q&A session now. Thank you.
Hi, good morning, Mr. Richard. Munesh from AmBank. I noticed on World Bank's report that they are projecting the Malaysian debt to go above 55%. What kind of repercussions that we'll be seeing if we are actually going into that stage? Thank you.
Hi, Shadida. Do you want to go one by one, or collect a few questions?
Maybe it's easier for you if we get another 1 or 2 questions, and then you can answer in one go.
Okay.
Okay. Richard, I've got a question actually from Anthony Das. He's not able to join us today. His question is, how deep and sustained is the demand destruction from the virus impact, and what extent consumer behavior fundamentally changes in the future? I think there's been a lot of talks about the change in lifestyle, the change in behavior after this, after the phase of this COVID. So could you comment on that as well? Any questions?
Hi, this is Lillian from East Spring. Okay, a few questions. This is on the base case assumptions that you've made for Malaysia. How long are you assuming this MCO continues for? And then your take on unemployment. Thank you.
Okay, maybe I can have a go with those three. So firstly on debt. So, I mean, debt is a little bit of a moving target in Malaysia because all we know for sure is we know what government intends to spend, and that's been outlined in the various stimulus packages. We have a projection on how much we think government can collect, perhaps slightly different to MOF, but that's projecting growth rates and commodity prices across the major buckets of revenue. And then essentially we have to make some assumptions or inferments on how much can government reallocate spending within categories. And we shared a little bit about where that's possible and where it's not. And how can government sort of optimize its position given the constraints that it faces. And of course, the big one is that government cannot borrow to fund operating expenditures. And nearly all of the fiscal measures in the stimulus package are by definition and by necessity operating expenditures. The wage subsidy, the additional cash transfers, the BSH, and the BPN. So, I mean, essentially, we're sort of projecting a deficit and a debt level based on that. And I think what remains to be seen is does government decide absolutely it has to stick within the existing legal instruments, which means essentially finding an awful lot of non-tax revenue, essentially raiding Petronas, or will it look at in some ways of trying to relax some of those fiscal rules? Either way, I think it's clear that debt is going to go up significantly. I think in terms of the implications of that, well, there's the narrow implications, which is legally. Would government want to breach the 55% and then do something about it afterwards, or perhaps announce that that cap has been lifted temporarily before the number passes over that? That we'll see. But does it really matter? I mean, our assessment is that this is perhaps this is the reason why governments deploy fiscal resources to deal with a crisis like this. And perhaps we're worrying too much, at least in the short term, around fiscal consolidation. Sort of sovereign credit rating is perhaps less of a priority at this point in time. In fact, I think Malaysia's medium-term sovereign credit rating is probably better served by dealing robustly with the crisis in the short term, and then returning back to a fiscal consolidation pathway more sustainably in the medium term. Secondly, in terms of how deep and sustained are the behavioral changes, I mean, I think it's useful to think of sort of impact in two areas. One is consumption and economic activities, which essentially is just being pent up. So people decide not to buy a car now, but they still need to get a new car, and they will do so eventually. And essentially, that sort of demand element is not so much lost as deferred, and so that's one of the reasons why we would see a sort of recovery or acceleration in consumption after the crisis. And then secondly, the extent to which consumption is essentially lost. So people decided, we're planning to go on a trip in March. March came and went. They were locked down at home, and that consumption never happened, and essentially it can never be recovered. And so, it's hard to sort of disentangle how much of demand which is being disrupted will be pent up and can be potentially recovered afterwards, and how much essentially is lost. And that's why we sort of, even though we sort of project a recovery, that part of that demand or the economic activity will never be recovered in aggregate terms. In terms of behavioral change, I think we would expect to see quite a bit. I mean, our sort of projection is that even when the MCO is lifted, we would expect to see only a partial recovery or lifting of restrictions over time. And I think it's almost certainly the case that sort of social distancing is the new norm, and so that's going to affect the way that many businesses operate, particularly in the sort of retail hospitality sectors. It'll affect the way factories and economic activities are deployed. I think it would almost certainly, especially in Malaysia and advanced economies, accelerate efforts to automate, mechanize, and modernize manufacturing. There was already a lot of pressure on that already. I think this will perhaps add even more to that process. And I think it's clear that now that many people have been forced to work from home, they will actually probably have new preferences about staying much more in that mode, at least partially and under periodic amounts of time. I think Malaysia is quite well placed for that, as I mentioned before. I mean, this is a country that has, by our estimates, one of the world's highest rates of digital adoption among citizens. So Malaysians are kind of very savvy and familiar with using digital technologies and able to work by distance. But of course, what's important and what we're worried about is that's not distributed evenly. There are many jobs that can be done from home and many jobs, particularly those on sort of lower pay and lower incomes, that cannot. And so there's sort of concerns about the extent to which people at the bottom end of the distribution of income can actually able to sort of maintain incomes under a new normal of social distancing. Firstly, on the sort of our assumptions, I mean, our baseline is the MCO would be perhaps maximum. I think we said in the end maximum 6 to 8 weeks, at least in its most restrictive format, and then probably a sort of sliding scale, gradual lifting of restrictions, probably first in manufacturing, and then more slowly in services, that would allow for a sort of a broad-based recovery in industrial production by the fourth quarter. The lower case, of course, is perhaps a more sustained period and a deeper contraction in the external demand, affecting not just the ability to restart supply, but also the demand, particularly in tradable sectors. In terms of the impact on unemployment, I mean, certainly we would expect unemployment to tick upwards in Malaysia. I think probably what will be the bigger impact, though, is what we would say an underemployment. I mean, what's remarkable in Malaysia is it almost doesn't matter what happens in the economy, but Malaysia's unemployment numbers stay pretty much the same. I mean, the historical trend for that number is basically 3.2%, with very little plus or minus. Where we do see a lot of change is in labour force participation, and then measures to assess the intensity of economic activity in the workforce. And what we would expect, I mean, well, what's been encouraging over the last sort of 5 years has been this sustained increase in labour force participation, quarter on quarter, almost sort of relentlessly. And that's one of the reasons why we've seen consumption numbers growing quite strongly from a GDP perspective, even if wage growth has been fairly modest. So essentially, there have been more wage earners in the economy consuming, and that's affected aggregate demand. I think almost certainly would expect that to tick downwards. Many people will essentially step back out of the labour force and not participate. It might take much longer to return to the labour force, or will have a number of constraints, including their ability either for sort of personal, family, and sort of school care and home-based responsibilities, particularly for women, that will make it harder to go back into the labour force when restrictions are lifted. And so I think there's quite a risk that we see a relatively less employed workforce, even if the sort of headline unemployment number doesn't change by that much. Back to you, Shalida.
Okay, Richard, I've got questions from the chat. I'll just read it out to you. From Raj, what are the views on the USD in the next 12 to 24 month time frame? A lot of fiscal easing. How much more can the world take? That was question number one. And question number two is how dependent, this is from Bursa Malaysia, how dependent is the Malaysian economic recovery or stabilization on the regional and global recovery? Unique opportunities for us to capitalize on to buck the trend? Those two questions for the moment.
Okay. So the first question is both on the dollar and the sort of scale of fiscal easing in, I assume, the US and advanced economies. I mean, what's been striking is that although we've seen sort of EM currency weakening, we haven't necessarily seen so much dollar strength, and I think that reflects a lot of skepticism about how effective the US would be, partly because it's sort of started in China, then shifted to Europe, and now thirdly the sort of latest epicenter in the US. And questions about the degree of policy response that the US would mount. I think that's sort of beginning to ease somewhat. I mean, certainly we'd expect the dollar to continue to be a safe haven throughout this period, reflecting, of course, just the sort of centrality of the dollar in the US economy and the sort of scale of Treasury bill offering and the sort of benchmark role that they play in terms of risk-free assets. Although we see that perhaps even more so now in European public sector debt as well. In terms of how much fiscal easing can the world take, I mean, advanced economies essentially economies that issue debt in their own currency, of course, are in a vastly stronger position compared to countries that are unable to do that. Of course, Malaysia is fortunate in that sense as well, that it has not dependent on foreign capital, or at least foreign currency denominated debt. I think if you look on a global scale, there's still quite a bit of scale. I mean, some of the world's most indebted economies, for example, Japan, have debt levels well over 200% of GDP. Most European economies, perhaps with the exception of Italy, are well short of that. I think the bigger question is, how long is this needed? I think there's probably not much question that most advanced economies can undertake sizable fiscal stimuluses within this year. But if we see a very slow and protracted recovery that necessitates continued stimulus of various sorts, then increasingly countries will have to make choices about how much they can afford versus how much remaining space they can have. And I think perhaps the most interesting dynamic within the European Union is going to be the extent to which countries tolerate cross-subsidization. Because the reality is the most affected countries, Italy and Spain, are the ones with the least fiscal space relative to, say, sort of Germany and some of the other economies. On the second question on how dependent is Malaysia's economy, recovery and stabilization dependent on regional external demand, so certainly Malaysia is a very open economy, well over 130% of GDP. So, and that's one of the reasons why we see quite a big difference between our baseline and lowercase scenario for Malaysia, because if the external environment is that much more poor and challenging, then the impact on Malaysia, particularly its tradable sectors, is that much more significant. So clearly, it would be a lot more hard for Malaysia to recover if we see a deep global recession, and in particular, if we see a significant underperformance in China. Now, certainly the high-frequency numbers from China suggest that the recovery there is coming very rapidly. I mean, we were all surprised by the depth of economic contraction in February, but then the pace of economic recovery in March. And so if that continues, if China is strong, but we see very weak positions in Europe and the US, then that provides some mitigation for Malaysia. But I think what's most likely is, once Malaysia sort of exits the crisis response mode beyond the MCO and starts looking to an economic recovery phase, then the response, from a policy sense, starts to look more like what Malaysia's done in the past, which is this sort of debt-financed development spending. And perhaps it will be, this is the time, perhaps more than ever, to sort of stimulate demand through capital investment, particularly on the infrastructure side. I think it would be unfortunate if kind of this crisis leads to a sort of focusing on sort of domestic economic activity, because Malaysia will always be a relatively small economy and has benefited a lot from international integration and participation in global value chains. But certainly, I think there's going to be a lot of pressure now on sort of building resilience into those supply chain in terms of looking at diversification of trading partners, products, components, and inventory. Thanks. Oh, I think you're muted, Shalita.
Thank you, Richard. I think we have time for one or two more questions. Is there any more questions from the participants?
Yes, I have a question. This is Yasmin from PNB.
Hi, Dr. Yasmin.
Hi. The lockdown to China. Do you think the world has awakened up to the fact that there has to be more diversification in terms of supply chain relocation, especially for medical devices, for medicines, and that we could see a movement away from China, perhaps to relocate in Southeast Asia or other countries, because it is, for example, China produces 80% of US antibiotics. So if China shuts down in a lockdown, that actually jeopardizes the US or any other country which depends on China. So for security, we will see a relocation out of China, perhaps, and to an even spread of supply chain. And this could perhaps drive inflation going forward. So we may end up with higher prices in terms of overall in the world. What is your comment?
Hi, sorry, this is Sam from Yinson. I have one question. I know that the banks are better capitalized now than the last crisis. Is there any view on possibility of credit crunch in the market in considering the impact of the COVID and social distancing on the SMEs? Thanks.
Okay, let me try both of those. Firstly, I mean, I would very much agree with your sort of thinking there on sort of supply chain reconstruction and rebuilding in a post-crisis world. In many ways, I think we were already heading in that direction beforehand. I mean, before COVID came along, the biggest issues were related to US-China trade tensions, concerns about imposition of tariffs and what that means for the integrity of global supply chains, and increasingly, I think, GDP operators looking to balance not just sort of lowest cost production with most secure production based in multiple sources. So I think recent events would massively accelerate that process. I think what we don't know is, will we see a kind of lowest case denominator where essentially countries and governments insist on having a higher level of residual domestic consumption or production to support sort of worst case outcomes of global shutdowns everywhere and shutdowns in global trade? Or do we just see a sort of rebalancing of international trade around, somewhere between lowest cost, but also efficiency and distribution of production across production nodes? I think in that first scenario, things would be tougher for Malaysia because you would see a demand not just to move production out of China, but actually close to sources of final demand, particularly in Europe and North America. Or is the sort of that second scenario is probably one of much more opportunity for Malaysia, where there's the possibility of sort of taking market share and being, playing a bigger role in sort of regional production networks. I think it's quite hard to tell exactly which way we're going now. We've seen kind of some discouraging, policy choices already imposed. For example, some of the export bans on medical products, but also some sort of encouraging noises as well from other parts of the world. The second question on sort of credit crunch SMEs. I mean, I think the real question is, how much of Malaysia's, industrial production and economic structure, and particularly SMEs, can survive and preserve their sort of structural integrity during the MCO period and the sort of post MCO recovery period. I think there's if there's enough in the stimulus packages and the shutdown is short enough and the recovery comes fast enough, then I think we can be optimistic. But if any of those sort of elements in that equation are longer or deeper than expected, then it will become that much harder to sort of regain economic activity and production in a post-crisis period. And of course, that would have direct implications on the financial sector.
Hi, Richard. Darren here from Fiscal. Just to follow up with the earlier question on consumer spending. There was a recent survey that was published saying that the Malaysian economy, you have 60% being contributed by private consumption. And private consumption is at risk because the survey says that 60% of households are actually looking, households are looking to cut down 60% of spending. So even with a 1.6 growth that you guys are estimating, do you think that's on a base case scenario? Do you think that's even too optimistic? Thanks.
Thanks. Was there a second question coming in at the same time as well?
Yeah, this is Eugene from Principal. Richard, just going back to your point on the Malaysia's debt ceiling, and from the just want to get your insights from the point of view of the three rating agencies. What has been the precedent set in terms of times of crisis, in terms of leeway for breaching the debt ceiling and other metrics that they look at? Based on other countries and based on the previous crisis. Yeah, that's all.
Okay, thanks. So on consumer spending, yes, so consumption is 60% of Malaysia's GDP, although, I think you have to be careful. Often there's a temptation to think consumption just, is somehow bad or is some sort of, negative economic activity compared to industrial production. Whereas the reality is, that consumption number from a GDP accounting basically includes services as well. So essentially, Malaysia's economy is broken up into sort of manufacturing, industrial, public sector economic activity, agriculture, and then consumption. But consumption includes, the entire services sector and so on. So it's not just, people buying things from the supermarket, but also that whole sort of segment of economic activity. Yes, of course, numbers have taken a massive dip and a massive hit. But there is a residual sort of minimum level of economic activity. I mean, our sense is that the services sector as a whole in Malaysia is able to function much more during the MCO period than the industrial sector. And as I mentioned, some of that consumption is lost, but others is sort of pent up demand that we would expect to we would see entering back into the economy once we get into a recovery phase. 1.6% is I guess it's optimistic if we see a deeper than expected contraction or a longer than expected period of restrictions. But that's also a very dramatic change in a number that's been remarkably stable for an awfully long time in Malaysia. In terms of the debt ceiling, Malaysia faces sort of multiple constraints on the debt and expenditure side. Some of them are domestically imposed. This 55% limit is a uniquely, Malaysian legal ceiling. It's not imposed by any credit rating agency. Other countries have similar numbers. Other countries don't publish a particular number. I guess its usefulness has been in that it's acted as a disciplining force in Malaysia for many years. The question now is it more useful to consider temporarily breaching that, or is it better to sort of preserve that ceiling, even whatever the cost on the domestic economy? I think we would probably argue towards a temporary breach being more appropriate. The reality is that there is no country in the world now that is not facing deep fiscal pressure and pressures on sovereigns, and so Malaysia is not any different to any other economy that sovereign credit rating agencies are looking at. All that we have in terms of precedent is the more recent crises, the GFC, the AFC, and some of the sort of Euro crises. But most of them have been issues around demand shocks rather than supply shocks. We don't really have. You have to go back to sort of wartime economic history to find examples where economic activity is constrained by lack of domestic supply because of specific policy choices, rather than more traditionally a shock to external demand. In which case, there isn't an awful lot of lessons from the past to guide us. I think when you look at other EMs, of course, Malaysia is relatively more indebted than a lot of the comparators, particularly in this region. But then if you compare Malaysia with advanced economies, the current levels of debt actually give a little bit of headroom. If you sort of listed Malaysia up against most sort of medium-sized European economies, the level of fiscal space and borrowing space is not too bad. If we assume that this is a sort of sharp shock and a sharp fiscal response this year, and then moving more into a sort of public sector development budget finance recovery that sort of gradually subsides back onto a fiscal consolidation pathway over the medium term. Thanks.
Any last question for Richard? Okay, there's no more questions. I think we have come to the end of the first session with World Bank, and thank you very much, Richard, for sharing with us all your insights. We just to let everyone know that the slides that Richard presented is available, and we can forward it to you by email. And it also has Richard's email address at the back. You need to clarify anything else further. Thank you very much, Richard.
Great, thank you very much. Yes, happy to discuss or answer any questions or any follow-up by email from anyone who's listening. Thank you.
Okay. Richard, you're most welcome to stay on for the next session as well, in case there are other questions. All right. We shall now move on to our next session, which is the stock market outlook, which will be presented by our head of research, Joshua. And